Welcome back to the Wall Street Podcast. Today, we're doing a deep dive into a new research report from JPMorgan Securities LLC. It's called Short-Term Market Outlook and Strategy, Doves Land in Jackson, and it just came out on August 22nd, 2025. We'll be looking at what it says about the Fed's policy direction, money market dynamics, and the outlook for short-term funding.
Right. And the report really kicks off by highlighting quite a significant shift, wouldn't you say, in the Fed's policy stance. Chair Powell's comments at Jackson Hole, they were pretty dovish. And markets reacted immediately. We're now seeing nearly a full 25 basis point rate cut priced in for the September meeting.
Almost fully priced in. Okay. And for the rest of the year?
Markets are looking at 2 total cuts by year-end.
Here's rare.
Interestingly, JPMorgan's own economists, they're forecasting something more aggressive. They actually project a 25 basis point cut next month, so September, but then followed by 3 more cuts of the same size at the next meetings.
So 4 cuts total this year, according to JPMorgan.
Exactly, 4 cuts. And what's really notable is that this expectation for quite aggressive easing comes even though the Taylor rule, the framework that suggests optimal rates based on inflation and output, well, that rule suggests current rates are actually kind of appropriate for the current macroeconomic conditions.
So there's a disconnect there. Market sentiment and maybe forward guidance seem to be driving things more than the traditional models right now.
Precisely. It suggests expectations are really powerful at the moment.
Okay, let's shift gears a bit to money market liquidity. The report mentions the Fed's overnight reverse repo facility, the ONRRP. Cash levels there have really plunged.
They certainly have, down to $36 billion as of August 22nd. That's the lowest we've seen since way back in April 2021.
And just to remind everyone, the ONRRP is where institutions park extra cash overnight. So low balances mean less cash is being drained that way.
Right. Which means bank reserves are now having to absorb a bigger share of the liquidity drain, especially, as the Treasury rebuilds its account. The report does expect repo levels to firm up towards month end, though.
Why is that?
Several factors. You've got cash leaving from government-sponsored enterprises, the GSEs like Fannie and Freddie adjusting liquidity. Plus, about $62 billion in new T-bill supply hitting the market, and $36 billion in coupon settlements, all pulling on short-term cash.
Okay, so some upward pressure on repo rates expected, but are banks showing stress?
Not currently, according to the report. No signs of stress right now. However, there's a caution. Liquidity risks could pop up if investors start shifting money out of repo and into longer-term assets, trying to lock in yields before rates fall further.
That makes sense. So, looking at the Fed policy again, JPMorgan's forecast is quite a bit more aggressive than the market's overall view. How does that shape near-term expectations specifically?
Well, as we said, the market sees maybe 2 cuts. JPMorgan is calling for 4, starting next month, and continuing monthly. It implies they believe the Fed is really set for a more sustained easing cycle than what's currently priced in. Even with that Taylor rule suggesting maybe less urgency is needed, it's a key point of difference for investors to track.
Definitely. And with those ONRRP balances basically scraping bottom, what are the direct implications for funding conditions? Where should we look for potential stress points?
Well, the near zero on RRP means reserves are really bearing the brunt of liquidity absorption now. We expect repo rates to firm up, as we discussed, due to supply and settlement near month end. While banks seem fine now, that potential rotation out of repo into longer maturities is the thing to watch. If that happens significantly,
liquidity could tighten.
It could put pressure on funding markets, yes. And that's where the Fed's standing repo facility, the SRF, comes in. It acts as a backstop. If market funding gets tight, banks and primary dealers can access liquidity there.
Okay, so the SRF is the safety net. Given all these moving parts, what are the critical things investors should be monitoring right now?
Several key metrics. Definitely keep an eye on overall reserve levels in the banking system. Also, money market fund assets under management, or AOMs. And within MMFs, watch their weighted average maturities, the WAMs.
Why the WAM specifically?
Shorter WAMs mean MMFs are staying very liquid, perhaps anticipating rate changes or needing flexibility. Longer WAMs might suggest they're reaching for yield. It indicates their positioning. Also, crucial to watch are the key rates themselves, SOR, the Secured Overnight Financing Rate, and TGCR, the Treasury General Collateral Rate, both the rates and the volumes traded.
And economic data releases too, I assume?
Absolutely. They are critical near-term catalysts. We've got real GDP for Q2 coming up on August 28th, Then PCE inflation data on August 29th, that's the Fed's preferred measure. And of course, the big one, the employment report on September 5th.
Okay, lots to track. So let's bring it home. What does all this technical detail mean for you, our listeners?
Well, these expected rate cuts and the shifts in market liquidity, they can have pretty direct impacts. Think about borrowing costs. We could see changes filtering through to consumer loans, business loans, maybe mortgage rates eventually moving lower. On the flip side, the yields you get on short-term savings, like in money market accounts, those could start to edge downwards too.
So potentially an environment of somewhat cheaper credit ahead.
Potentially, yes.
Yeah.
But it also really highlights how sensitive your own financial situation, your savings, your borrowing can be to these ongoing shifts in Federal Reserve policy and market plumbing. It pays to stay informed.